Hello and welcome to another video on US taxation. So today we are here to present on income from interest and dividend. So in the previous chapter we discussed income from salary, which represent the most common type of income earned by the individual through employment. We explored how wages, bonuses, allowances and other employment benefits are taxed and reported on the individual tax return using the form W-2, which is being performed for an employer. And salary income reflects the active income, meaning it is earned through the personal efforts and the services. However, taxpayer often earn income from sources other than the employment. So one of the most important category of such income is investment income. Investment income arises when individuals allocate their savings into financial assets such as banks, deposit, bonds, or share of the company. So instead of earning income by working, the taxpayer earn income because their money is working for them. So two most common form of the investment income are the interest income and the dividend income. Form 1099 INT is for interest income and Form 1099 DIV is for dividend income. Although both interest and dividend income fall under the category of the investment income, they differ significantly in terms of the tax treatment, reporting requirement, and the applicable tax rates. Therefore, in this chapter, we will explore what constitutes interest income, different type of interest income and their tax treatment, the concept of dividend income, the distinction between the ordinary dividend and the qualified dividend, the role of 1099 INT and 1099 DIV, and understanding these concepts in detail. So let's just start the discussion. We'll move to the first slide, which is the agenda slide. Okay. So the key agenda that we're going to cover today is we'll quickly understand the concept of the investment income. We'll understand what is interest income and what are the different type of interest income, and then how this interest income is reported by the payer of the interest, which is 1099 INT, tax treatment of the interest income, and likewise we'll also have a look at the dividend income, type of the dividend, which is qualified versus ordinary, and understanding the concept of Form 1099 DIV, which is being issued by the company who pays the dividend, and the tax treatment of the dividend income. We'll also have a complete understanding by looking at the example that how interest income and dividend incomes are taxed. Then we'll quickly have the final synopsis of the uh, today's chapter by looking at the key takeaways. So we'll start the discussion by moving to the first slide. Okay. So, investment income. What is investment income? So, investment income refers to the earning generated from financial assets rather than wages of the business. So, which means that the capital which has been earned on the money which has been earned that has been put to use in form of the deposits, or they have been used to purchase the shares, which later on yield the return in the form of the dividend. So the common sources of investment income includes the interest earned from the saving account, dividend received from the stock investment, capital gain from selling the investment, and the rental income. So in this chapter, we're going to cover about two elements, which is the interest income and the dividend income. So why it matters in taxation? Because it increases the total taxable income. Different type of the investment income receives a different tax treatment, and tax forms such as 1099 INT and 1099 DIV reports this income to the IRS. So example, an individual earning salary of 60,000, 2,000 is bank interest and 3,000 dividend. He has to report the total income to the IRS as 65,000, which includes both the income from the interest as well as the income from the dividend. So we'll move to the next slide and understand the concept of interest income. So interest income, we'll talk about what is interest income. So interest income is the compensation received for allowing the someone else to use your money. So which means that if our money which we have parked with the bank in the form of the saving account, or the money which we have parked with the bank in the form of the fixed deposit, or any kind of the bond that we have purchased from the government, or from treasury bonds. So all those bonds that we purchase, they yield the interest. So basically, the interest is being given by the banks if we have make the deposit with the bank, financial institution, some corporation, and definitely the government entities. So common example includes saving account interest, fixed deposit or certificate of deposit, corporate bond deposit, and the treasury bond interest. So tax rule is that interest income is generally taxed as the ordinary income in the taxpayer's regular income tax rate. So which means that the interest income is clubbed with the all other income of the assessee, and that income is subjected to the tax basis the rates that is applicable to that individual basis the income tax brackets. So if a taxpayer earns interest of 1500 interest for the bank account, it must be reported as the taxable income. So we'll move to the next slide. Okay, we'll quickly talk about type of the interest income here. So interest income may come from several sources. So we'll first talk about the bank deposit interest. So interest earned from the saving account, checking out, and the CDs are treated as interest income, and tax rate means that entire amount of the interest which is being received is fully taxable. Likewise, for corporate bond interest, interest paid by the corporation to the bondholders, tax treatment is fully taxable at the ordinary income tax rates. US Treasury interest, so interest earned on the US Treasury securities. So tax treatment taxable at the federal level, exempt from the state and the local tax. If Treasury bond is being issued by the US authorities, US Treasury securities. So it's being taxed at the federal level and not exempted at the state and the local taxes. Municipal bond interest is reverse. It is usually deferred, usually tax-free at the federal tax level, but it is being taxed at the local level, and sometimes is also exempt from the state level if issued at this in the same states. And then the original issue discounts, interest that accrues gradually on the certain bonds reported annually, even if they're not received. So which means that the interest got accrued and that is being paid on the maturity, but the individual has to report the accrued interest for that particular year in the form 1040 when an individual filed the return. So we'll move to the next slide. Okay, now we'll talk about form number 1099 INT, which is being issued by the payer of the interest. And like we discussed the form W2, which is being issued by the employer, we are going to discuss the form 109 INT, and we'll cover all the boxes that are there. So form 109 INT reports the interest income earned during the year. Banks and the financial institutions, this form of interest paid exceeds 10. So if the interest paid for a particular period, year, accounting year, particular income tax year is more than 10, then it has to be reported by the banks and the financial institution to the form 109 INT. Purpose is to inform both the taxpayer and IRS about the interest income received. Key boxes in 109 and INT is that box 1 is the interest income, total taxable interest received. Box 2 covered the early withdrawal penalty paid for the withholding deposits, withdrawing deposit early. Interest on the US saving bond and treasury obligation. Box 4 is the federal income tax withheld, the tax which has been withheld by the banks or the financial institution. Box 5 is the investment expense, which was there. This is like deductible before, some time, but it is currently not deductible. So which means that this is only for the reference purpose. Box 5 is not being used because the investment expenses are not currently not deductible in the current tax structure. Foreign tax paid, so which means that taxes which is being the interest which is being earned in the foreign country other than the US, that taxes paid to the foreign government or the foreign interest income needs to be reported here. And the foreign country or the US position, the country where the foreign tax was paid. So typically, any interest which has been earned from the foreign sources, the tax which is being withheld from by the foreign source, that needs to be disclosed in the box number 6, and the country from which it has been sourced needs to be mentioned in the box number 7. And then the individual can take the credit of that interest or the interest tax credit, whichever is beneficial to that particular interest SSC, he can claim that benefit. And then the tax exempt interest. So interest which is exempted from the tax is typically a municipal tax interest when we are talking about the federal form 1040. So interest income 1200, treasury interest 200. Just example here: federal tax withheld 0, investment expense 25, foreign tax paid 30, and the foreign country from which it has been taxed in Germany, tax exempt interest is 500. So this is a form in which the information is being reported by the financial institutions to the IRS as well as to the individual, and then individual uses this information to fill the 1040 return. So we'll move to the next slide. Okay, so now we'll talk about the treatment of the tax on the interest income. So interest income is generally taxed at the ordinary income. This means that taxed at the taxpayer regular income tax bracket. This is the brackets that we have. So it's being taxed at this is the income which is being earned by the individual. That interest income is added to the total income, and then the tax bracket is applied. So a financial institution issue form 1019 INT when interest paid exceeds 10. Important reporting boxes include box 1, which is taxable interest income, box 3, which is US Treasury interest, and box 8, which is the tax exempt interest. Tax reporting, return reporting, the interest income is reported in the form 1040. Line 2A, which is the tax exempt interest, and the line 2B, which is the taxable interest. So if total interest income exceed 1500, taxpayer must also file the schedule B. So there's another schedule that needs to be filed by the taxpayer if the total interest in a particular income tax year, particularly in which income needs to be assessed, exceeds rupees $1500. So what are the steps? What are some of the key pointers that we need to understand for the interest income? Interest income is usually taxed as an ordinary income. Financial institution report the interest using the form 011099 INT. Interest is reported on form 1040 in line 2B. Treasury interest is state exempt tax. Municipal bond interest is federal exempt tax. And if interest income is more than 1500, Schedule B is also required to be filed by the individual. So we'll move to the next slide. Okay, so now we will talk about another important element of investment income, which is the dividend income. So what are the dividends? So dividends are the payment made by the corporations to the shareholders from the company's profit. Companies distribute dividend as a reward for investing in their stock. So dividends are commonly paid, sometimes it's quarterly and annually. Normally, interim dividends are paid quarterly, and final dividend is paid annually. Example, if a company declares a dividend of $2 per share, then investor owns 500 share. The total dividend received is $1,000. Dividend are reported in form number 1099 DIV. So we'll move to the next slide. Okay. Now we'll talk about type of dividend here. So there are two type of dividend, which is the ordinary dividend, and then we have qualified dividend. So dividends are distributed by the corporate profits paid to the shareholders, and the information needs to be reported in form number 1099 DIV. Ordinary dividend and the qualified dividend are the two categories. Ordinary dividends, most dividend falls under this category, which is taxed at the ordinary income tax rates. It has to be reported, ordinary dividend reported in the form box 1A of the form 1099 DIV, and they are included in the taxable income in the form number 1040. Qualified dividend are the dividend receive preferential tax treatment similar to the long-term capital gain. Uh, uh, which means that the rate which is applicable is the long-term capital gain here. What are the conditions which permits a particular dividend to be qualified dividend? If dividend is paid by the U.S. corporation or the qualified foreign corporation, then it is treated as a qualified dividend and share held for more than 60 days. So these are the two conditions needs to be satisfied before a particular dividend can be treated as the qualified dividend. So first that the dividend must be paid by the U.S. corporation or the qualified foreign corporation, the list which is normally publishes on annual basis, and then shares in that particular U.S. corporation or the qualified foreign corporation should be held for more than 60 days. Then it would have a preferential rate, which is the rate which is applicable to the capital gain tax. So it will have a 0, 15, and 20 bracket depending upon the income criteria on which these rates would be applied. Now, if we quickly look at some of the comparison between the ordinary dividend and the qualified dividend, so ordinary dividends are taxed in the range of 10 to 37%, which is the normal tax rate of the ordinary income. Qualified dividend are taxed at the capital rate gain tax, which is starting from 0, 15, 20 brackets. It is being reported, ordinary dividend is reported in box 1A of 1099 DIV, and it is reported, the qualified dividend is reported in box 1B. Tax advantage is not there because ordinary dividend is normally included as a part of the normal income, and it's being clubbed to calculate the total tax on the total income. But for qualified dividend, the lower rate is there because the applicable rates of the capital gain tax applies here. Holding requirement is there's no specific requirement for ordinary dividend, but for qualified dividend must meet the 60 days holding rule. So with this, we move to the next slide. Okay, now we will understand the form 1099 DIV. The way we understand the form 1099 INT, same way we are going to talk about each of the box specific to 1099 DIV. So form 1099 DIV is issued by the corporates, mutual fund, brokers, or the financial institution to report the dividend and the other investment distribution paid to the investor during the tax years. A payer must issue the form 109 DIV when the dividend distribution exceeds $10 in tax year, and the form is sent to the taxpayer and the internal IRS, Internal Revenue Services. The purpose of 109 DIV is to ensure that dividend income is properly reported to IRS, investor correctly classify ordinary versus qualified dividend, capital gain distribution from mutual funds are taxed correctly, foreign taxes paid on the dividend are properly claimed as the credits. So structure 1099 DIV, first is box 1A, the total ordinary dividend. Second is box 1B, qualified dividend. So all this information needs to be disclosed, and each box is specifically pointing to a certain set of the information that needs to be provided. So we move to the next slide and see what is there for the what is the content of the other boxes for 1099 DIV form. Okay, box 2A is total capital gain distribution. This box report the capital gain distribution for the mutual fund to the REITs. These are treated as the long-term capital gains regardless of how long the investor held the investment income. Capital gain distribution, just example here. Then box 3 is non-dividend distribution, also called the return of the capital. These distributions are not immediately taxed. Instead, they reduce the investor cost basis in the stock. Initial investment was, for example, initial investment of 10,000, non-dividend distribution is 500, new cost basis is 9,500. Tax will apply when the investment is sold. So typically, this is a kind of a scenario in which is not a specific classification of a dividend income. This is a non-dividend distribution, and hence it is not being taxed. It is being received whenever the investments are finally sold. The capital gain which arise at the time of sale, that is something which is subject to the tax, and the amount which is being received as a non-dividend distribution, that reduces the cost of the investment, so that once the investments are sold at the later point in time, the reduced cost will only be will be used to set off against the sale consideration. Box 4 is the federal income tax withheld, shows any backup withholding tax deducted by the taxpayer. Backup withholding tax typically applies when a taxpayer did not provide a valid taxpayer identification number. The IRS requires withholding. So rate is that. So basically, it treats about the withholding which is being done on the payout of the dividend. Box 5 is the Section 199A dividend qualified business income dividend. Box 5 reports the Section 199A dividend, also known as the qualified business income QBI dividend. These typically arise from the real estate investment trust, regulated investment companies such as the mutual funds and the investment. Under the tax cuts and the job cuts, taxpayer may claim 20% reduction on the qualified business income, including the certain REIT dividend. This reduction is called for. So basically, this is a specific case wherein the dividend is being distributed by the specific real estate investment trust and the regulated investment company. And this is normally treated as the qualified business income dividend. And the tax cut and job rates, taxpayer may claim they can claim the 20% reduction on the qualified business income, including the certain REIT dividend. So this deduction is calculated using the form 8955 and 8955A. So typically these are like very rare scenarios, but this form is there, and then we have to provide that information. So section 119A, which is dividend, qualified business income dividend, is specifically for that particular scenario. We'll talk about this in the detail as we move in the another section when we talk about the final computation of the income of an individual. So we'll move to the next slide and see a few more boxes then. Okay, box 6, which is the investment expense. Box 6 represents investment expense associated with the dividend income, generally from the regulated investment companies like mutual fund. Example of such expenses are portfolio management fees, custodian fees, administration costs for the management tax treatment. So before tax act and job acts, these expenses are allowed as miscellaneous itemized deduction. However, under the current law, these deductions are suspended for most taxpayer, and therefore box 6 amount are generally not deductible. It's like similar the same as the case of the INT form, 109 INT form, wherein the uh, interest expenses that was earlier available as deduction, they are not available for deduction to the taxpayer in current scenario. And then the box 7 is foreign tax paid, shows the foreign taxes withheld on the dividend income from the foreign investments. Foreign dividend, foreign tax withheld, and the taxpayer may claim the foreign tax credit using the form 1116. So this is like the same way the tax credit can be availed by the INT form 109 INT. Similar way, any tax which is being withheld from the dividend which is earned from the foreign companies, that can be used as the foreign tax credit. So we'll move to the next slide. Okay, now let's talk about the tax treatment of dividend income. So I think we have already discussed this. The ordinary dividend is normally taxed at the normal rate, which means that the dividend income is included in the gross income of the individual, and then it is being subjected to the tax. This is the tax bracket. But for the qualified dividend, this is basically special tax treatment wherein the rates which are applicable to the long-term capital gain tax are being used to tax the qualified dividend. So this is a special treatment for a qualified dividend. So we'll move to the next slide. Okay, now we have taken one example each to demonstrate the taxability of the interest and the dividend income. So in this slide we are going to cover about the detailed example for the interest scenario. So what we are saying that John is a taxpayer with the following income: salary income 70,000, interest earned from saving account 1,500, interest from corporate bonds 800, interest from municipal bonds 700. Interest income is reported using 1099 INT and included in form 1044, and John marginal rate of tax is 22%. So what we have to do, first step is that we have to identify the taxable versus non-taxable interest. So saving account is fully taxable, corporate bond interest is fully taxable, municipal bond interest is exempt from the federal income tax because this is being taxed by the local authorities. Step two is to calculate the total taxable interest. So taxable interest is the total amount of 1,500 plus 800, which is $2,300. Municipal bond interest is not taxed as federally. Step three is to calculate the tax liability. So we will use the same bracket to which that particular individual John is being subjected to. So we'll calculate the tax to 2,300 multiplied by 22%, which is 506. And interest income is reported as follows. So form 1099 INT will report the interest received. 1040 line 2A tax exempt, which is $700. From 1090 line 2B taxable interest, which is $23. $2,300, and then we have to pay the tax accordingly. And if some tax is being withheld, that will be taken as a tax credit. So we'll move to the next slide. Okay, so this is an example of dividend income. So Sarah owns shares in the several companies and mutual fund. During the year, she receives ordinary dividend 3,000, qualified dividend 2,000, capital gain distribution from the mutual fund 1,200, dividend income reported using the form 0199 DIV. Sarah tax bracket is 24%, the capital gain tax applicable is 15%. So what we have to do in the step one, we have to classify the dividend between the ordinary dividend, the qualified dividend, and the capital gain distribution. Ordinary dividend will be taxed as an ordinary income tax rate. Qualified dividend will be taxed at the capital gain tax rate, and the capital gain distribution will be taxed as the long-term capital gain tax rate. Step two is going to calculation of the tax, which is tax on the ordinary dividend, which is 24% tax bracket, which is applicable to Sarah. 15% will be used for the qualified dividend and the capital gain distribution. So that is total tax here. So ordinary dividend tax, qualified dividend tax, and the capital gain distribution tax. Total tax is 1,200 rupees. How it will be shown in the form 1040. We'll go to the next slide and have a look at that. So how it's going to get reported? So the form 1099 DIV box 1A will have the ordinary dividend. Form 01099 DIV box 1B will have the qualified dividend. 1099 DIV box 2A will have the capital gain distribution. 1040 line 3A, which is the return form. In the 3A, we have to mention the qualified dividend, and in 3B, we have to mention the ordinary dividend. So with this, we come to the end of this chapter. We'll quickly have a final look at this slide and look at some of the key takeaways from this chapter. Okay, so what we have learned in this chapter, we understood that concept of the investment income, and we also know that investment income is taxable. Whatever investment income has been earned in the form of the interest and dividend, that needs to be included in the gross income and would be reported in the form 01040. Interest income is generally taxed as the ordinary income tax rate. Some interests are exempt, which is specific interest which is being issued by the local authorities, municipal authorities, which is being exempt from the federal tax. And likewise, the interest which is being issued, which is being given by treasury security, those are exempt from the local taxes. All the interest income needs to be reported by the payer of the interest in the form 01099 INT. Same needs to be reported to the IRS, and form needs to be also shared with the income tax assessee, which will then be used by the assessee to file the form 1040. Dividend income is reported using 1099 DAV form, and there are two classifications of the dividend, which is ordinary dividend and the qualified dividend. And then we have a category of capital gain distribution. Ordinary dividend is normally taxed at the normal income tax rate, while qualified dividend has a preferential rate of a lower rate, which is being rate of the capital gain tax that will be applicable to them. And whatever investment income that is being held by the SSC that needs to be reported, they can take advantage of the lower tax rate for the qualified dividend, claim the foreign tax credit wherever applicable on both the interest and the dividend, and to ensure that they accurately report all that information in the form 01040 to avoid any kind of the penalties which is being imposed by the IRS due to the non-filing or the delay in the filing of the accurate information. So with this, we'll come to the end of this chapter. We'll go to the final thank you slide and look at that what all we have learned, and then what are we going to cover in the next chapter. Okay, so what we have covered in this chapter, we have covered the two important element of interest and the dividend, and how these income should be treated, and what is the reporting mechanism, and how that its income needs to be included. So we are going to talk about the next chapter, both of these category and the involved situation where the income earned either through the employment relationship or the passive income. However, many individuals earn income not as an employee but by running their own businesses. So working independently or providing the services directly to the clients. This type of the income is known as the self-employment income. Unlike salary income and the self-employed individual unlike salary income, self-employed individuals are responsible not to only for reporting their business income but also calculating the business expenses, net profit, and the self-employment taxes. So we're going to learn about the concept of the self-employment income, what are the various schedules, or how they have to report the income in the upcoming chapter. And we are going to cover this chapter as a form of the income from the self-employment. So we are going to come up with this new chapter very soon. Until then, thank you, goodbye, and have a nice day.